Okay, just started recording. Happy Financial Fitness Friday. Uh, Today, we're going to be talking about credit. This will be part one of two. This one's making sure, kind of explaining how credit works and how to be responsible with credit. And then part two, we'll get into credit card hacking and travel hacking. But the important thing is first to be responsible. Quick disclaimer. As mentioned, these are not meant for specific advice or recommendations. This is meant to be educational discussion, and this is interactive. So if you have questions, please answer. And I want to make sure, can everybody give me a thumbs up that they agree that I can post this recording on YouTube so that others can watch it for free? I made plenty of mistakes with money, as you guys know from before, but like here's a few of I was thinking of some of my credit mistakes. And one, like people that are military, like Steven, I remember I was on deployment, had no idea it was like $25 charge that I missed for months. You know what I mean? And when it was like Bank of America years ago, and they of course were not friendly, but that hurt me. But some of these, I think the first four are kind of the biggest ones. I didn't realize how closing your credit, you want to keep your credit open because it kind of impacts you how much utilization you have. But I was thinking, get ready for buying a house, that I didn't want all these credit cards open, and so I negatively hurt my credit for no good reason, just because I didn't understand credit. But now we'll kick off actually a quick poll. Okay, now I'm just sharing the results, and these are just the questions that we had. So let's see, 12 out of 13 said they use credit cards. I asked that because some people I know are like the Ramsey philosophy, we're totally against credit cards, but I see most here use them as I do. Let's see, do you maintain a balance? Do you need to maintain a balance on your credit card to improve your credit? 3 said yes, 9 said no, 1 said I don't know. You don't need to keep it balanced. That's like I think a silly claim that the bank, the credit card companies have pushed out there to, keep you to collect more interest. You need to use your credit cards if you just have credit and don't use it at all, but you don't need to carry a balance in order for it to actually improve your credit score. That's just not true. So want to make sure people knew that. Do you pay your credit card balance on time and in full balance every month? And that's great. 11 out of 13 said yes. 2 said no. The average revolving balance, 3 out of 4 have 0. 4 out of 13 less than 1,000. 4 out of 13 1 to 5,000, and 1 out of 13 5 to 10,000. So hopefully we can get more down the road down to 0. I know things come up, but these interest rates keep going up higher and higher on credit cards. They're like over 21% on average now. How close are you to reaching your limit on your credit cards? And this will go into because of the factors that influence your credit score. But 9 out of 13 said less than 10%, which is great. 4 out of 13 are 10 to 30%, and nobody is above 30% or higher, which is great because actually 30% is that point where it really starts to negatively impact your credit score in terms of credit utilization, meaning you're using much of your balance consistently. Even if you could pay that off every month, if it shows you use a ton, it's interesting. We'll talk about ways to do that. But like small business owners that might use it a lot, but then pay it off right away, there's ways to pay it quicker, I guess, and not have that high credit utilization. What is your credit score? Great. 10 out of 13 said 760 to 850. I put 760. When you look at the bands, it actually shows 740 to 850. But in reality, talking with mortgage brokers and things like that, 760 at least is the number you want to have as a minimum, even though when you look at, what do they say, excellent, good, blah, 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 it starts at 740 for excellent. 760 is really more important in reality. 2 out of 13, 680 to 759, and then just one person, 620 to 679. So and some of these, it just takes time for younger folks to build credit. And then we'll kind of talk about what it takes to how long it takes to build, how long it takes to repair credit. You prefer to use a credit or a debit card? 8 out of 13 said credit, 4 out of 13 said debit, and then 1 said no preference. We'll go into that. Actually, a credit card is much safer, which is to use than a debit card. So in reality, it's actually better. So long as, you know, and I sadly with plastic, whether it's debit card or a credit card, it's much easier to overspend compared to just paying with cash. But there's much better protection for you with a credit card than with a debit card. And then lastly, do you freeze your credit? 5 out of 13 said no, or said yes. 5 out of 13 said no. And how do you do that? 3 out of 13. So I've got a link in here that shows how to do it. It's really simple. It doesn't take long at all, and they freeze it within a day. So, but something I recommend everybody does consistently. Just have your credit frozen unless you know, and then you unfreeze it, which happens in an hour when you need to actually apply for something. Any questions there, or any thoughts about those questions or responses? Nope. Well, here's the quick agenda we'll go through. And like I said, if you have questions, you know, let me know. Anybody have an idea how much credit card debt there is in the US total? Total, yeah.
I
There's
don't
an
know.
there's an
100.
average. What's that?
You just want to guess like a
Yeah.
number? I don't know, like maybe what, 100 billion, 200 billion?
Times that by 10. Like it's at
Wow.
1.031 trillion dollars in quarter 2 of 2023. It's scary, the mountain of debt, you know, that there is out there, you know, and you know that's not people. I mean, that's debt. That's not paying off their balances. Here's a quick chart just showing, like, I don't know if you guys remember when COVID hit and they started doing those stimulus and everything. People actually were being responsible and paying down their debt, which was surprising to me. It was actually nice to see, and you can see that, you know, that drop off here, but then that ended in Q2. You know, the minimum was 70, even yeah, even then it was at 770 billion dollars of debt at the low, but it's quickly ramped up with, you know, inflation and just, you know, coming out of COVID, people just back to their normal, you know, their savings rates dropped again to our normal US levels of less than 10%. It's kind of scary. But yeah, there's a lot of debt. Here's the average credit card balance by age, which I don't like average. This is another thing where averages aren't as good as median. The middle number is actually better here because the average is always kind of is skewed, but it still shows. What I thought was interesting though is look at how much the people 75 and older, they have the highest average debt, and it's really there's only 28%, which you'll see on the next slide, but that's just kind of shocking. So, and I was looking at that, and I think part of it is look at it. There's medical debt, and there's sadly it's people not preparing for their retirement early, so they're on a fixed income. Then when prices go up, you know, suddenly they don't have any excess that they can use. That's kind of my assumption. It's hard to really guarantee, you know, show that, or the research I couldn't find any proof of that, but to me that kind of makes sense because you see it, like the percentages were pretty high for people that had very low income that were up um, in those age groups. So, but you see on the right though the percentage of people who carry debt. That's kind of scary. You know, fortunately there wasn't many people in our group on the poll that did, but it hovers around 50% in each age group that actually carry credit card balance debt. And like I said, this average number of 8,100 for people over 75 is skewed because it's only 28%. So you can imagine if the average is that, if the median is this and the average, they're carrying a lot more than 8,100 of credit card debt. So pretty scary. Any questions or thoughts on there? The next one I think is we're going to talk about income. Look at the the highest earners. Look at their average credit card debt, and they've got the highest average and median. They're carrying balances, yet they have the highest pay. Like, does that make any sense to you? To me, I think it just shows our consumerism as well, and the fact that having a high income doesn't mean wealth. You know, like sadly, I think they said there's right now 61% of Americans are living paycheck to paycheck, and sadly, even these high income earners, you know, 32% carry a balance, and their balances are high. It just makes no sense. And you wonder, you know, hopefully they're still saving for their retirements, but it's kind of sad. This is just a quick look. I know you can't read the numbers, but you can just see the graphs. That's the lowest 10% of income earners, then 25%, the median, and then 75%, 90%, and 99%. That's what the income earners are. And then it broke out just so you could see the different percentages. So the top 9, you know, it's at 90 to 100%. So that's in 2022, $212,000 of household income and above. They're carrying the most credit card debt. Does that? I mean, it just doesn't make any sense. But that's where we're at. Okay. Anybody? You've probably maybe seen this before, but like if you only pay the minimum payment, this is like how much you'll pay in interest. And I looked up various for various companies. So Chase, who has probably the most, Chase, Citibank, and Capital One, they charge 1% or $40 roughly, whichever is greater. American Express goes like 1 to 3%, so they might force a lot higher minimum payment. But 1%, if you're only paying 1% and you had a $10,000 debt and just paid the minimum amount, how long and how much do you think you'd pay in interest before you had that paid down?
I don't know, 47 years.
It's not quite that much, but it is a long time, Greg. Absolutely. How much do you think you pay in interest? 21 years and almost 16,000 in interest alone. So for that $10,000, you paid $26,000 in total. That's the opposite way you want to use compounding. So, but it's pretty scary, and I'm glad to see from our poll that most people aren't like that. But it's, you know, this is sometimes I think people need to see this when they aren't paying the. So I know some people that have debt and they're considering. I like it for points. That those points are meaningless compared to the amount you're paying in interest. So don't do that. Don't use the credit card if you have the debt. When you get it down and you can use it responsibly, then we'll talk points. Okay, the other thing is cars. Like, anybody know what's the average new car price these days, and what's the average length of a loan term?
5 years.
5 years. 5 years would be 60 months. That's
60
close.
months.
What's that?
60 months and $45,000, 45 to 50.
Close. Yep,
Price.
you're on. It's actually 48,000, but the average is 69 months. So 72 and 84 month car loans are becoming much more common. And the average length currently is 69 months. So almost 6 years long. How long do you guys own your cars?
So the wheels fall off.
Yeah,
Forever.
pretty much.
Forever.
Good.
I'm
Good.
awful. I swap once that warranty expires, car is gone. I know it's terrible. I get it.
I keep it as long as possible. So that's the problem with, like, here's the interest rates right now that you're finding even on cars. I bought one new car in my life. And then of course it got damaged immediately, which is, you know, it's just like fitting. It was like, you know, but I just made selected for commander and CO, and I felt like I had earned it. And of course, then it got broken into within 3 weeks. I let somebody drive it that wanted to test drive, and then he like scraped the rims against the curb. I'm like, okay, I'm an idiot. But the sad thing is, so like Maryland, like when your warranty goes away, you're probably underwater on that car. You probably owe more than what it's worth often. That's the scary thing with
Not me, because normally we actually pay more on the car. So a lot of the times, by the time my warranty has been expired, I've already paid off my car. My husband is very aggressive when it comes down to paying.
Yeah. No, that's good. And do you guys remember the 23-8 rule I've talked about before? It actually came from the Money Guy show, and I like that they have a standard, how much car can you afford? And they said, put 20% down, pay it off, no more than 3 years. It doesn't mean you can't get a longer loan, but you've got to be able to pay it off in 3 years. And that payment to pay it off in 3 years can be no more than 8% of your gross income. And that includes if you're married and have a spouse and both have car payments, it's your 8% of your total household income. So to me, that's a great thumb rule to use. And then I also like, they say invest more than, and you also need to be investing more per month than what your car payment is. I mean, it's scary now how much the average car, like cost of a car, people have $1,000, car payments. And imagine that with a 69 month, average car loan. It's just crazy how much people are spending. Right now, the AAA has good stats on cars. If you want never know like how much the real cost of buying a car. But right now they say it costs about $10,728 a year, nearly $900 a month to own and operate a new car. And since from 2018 to 2022, the new vehicle prices have jumped up 28.19%. It's crazy. And a lot of that's the shortage. So all these car companies only built their more expensive ones, through COVID. But it's still ridiculous how expensive these are. Any questions or thoughts on this? Okay, so FICO score. Anybody know what the FICO score, what that stands for and how long it's been around? Let everybody speak at once.
Who knows, man? It's not really know what the FICO is, but there's so many different agencies that track it that
yeah, there's 3 main credit bureaus, and before I was this is actually surprising. So in 1989, the FICO, which was, so it was Bill Fair, who was an engineer, and he got together with Earl Isaac, a mathematician, and decided, hey, let's come up with a standardized way, of doing credit reporting, because before it was, I guess, very hard. And that's why I was like surprised, like how we've only had real credit scores. I mean, in the 70s, a lot of companies were kind of using the Fair Isaac and Company, which turned into FICO, using their information, but it wasn't until 89 that it became standard. So I mean, that's what 30 just 34 years. And then recently though, in 2016, rent payments have been added. So previously it was just credit, mortgage, but all these other bills that you're paying on time that young people could really use to build their credit were not being used. But the recent FICO score that now rent payments can be added, they aren't automatically, but it also weighs medical debt less, importantly. And then they don't keep collection accounts that are paid off. They're not held in there. There's another score called the VantageScore with the 3 Equifax, Experian, and TransUnion. They came up with that kind of to compete with FICO, and so they have their own score. They're very similar, and initially they had different numbers, but they've all standardized to 300 to 850 for both of these scores, but 90% of top lenders still use the FICO score. But the important thing is to know when you look up your credit score, which is it? Which is your FICO? So you can get, like a lot of people use Credit Karma, and you can also get it your VantageScore by NerdWallet. They'll give it free. But there's for the FICO scores, you can go on, and I just did this. I've got a Citibank. I just went on the app, like my Costco credit card, and sure enough, just popped in and it immediately got my FICO score, and they're about the same. So one, I think they're within 9 or 11 of each other, so it was good. But any questions here on that? Like I said, a lot of times you might see your Vantage score, but when you're applying for something important, make sure you know what your FICO score is before going in, because that's the one that's going to be more important. And if there's a discrepancy between the two, that's important to know. Okay, here's
Alan, what's your take on applying for a loan and then that hitting your credit score?
So okay, so that's something I was going to go into. That's a hard inquiry, and it doesn't. Here's the thing: if you're going, Shane, my opinion, if you're going to apply for something important like a home or a car, a larger purchase, then don't apply for any other credit for a while, because those little hits do negatively impact your credit. You can restore them quickly, and they only last for 2 years. But that's a stupid hits. When say
Totally.
you're close to 760, don't do it. Don't do it. Or have your stuff frozen until you're ready to apply, get approved for that mortgage or that car loan, and then you can apply for credit cards. But travel hacking is not worth the amount of cost of dropping into a lower bracket, like a lower number, which really impacts, which we'll show here, how much bad credit or lower scores can affect you. But like I said, you see here on the excellent that says 740 to 850, but you really want, like I said, above 760, because that's where mortgage brokers, that's where the line is, more or less, where you want to be, where the numbers can make a difference. And then hopefully you guys can all see that the payment history is the biggest portion, and it, if you don't pay something on time, it's a hit. Every 30 days, it's a larger hit. So if you don't pay, if you pay within 30 days late, you take a hit. But if it's greater than 30 up to 60, it's a larger hit, and so on. And then after 120 days, it goes to collection, and then it's even worse. So fortunately, things are much better about automatic. I remember years ago where you couldn't even set up automatically paying your whole balance off in time. I had to call. This is why I hate Bank of America. Oops, that's recorded. Yes, I hate Bank of America and these other big banks. But I had to call them to make sure that my whole balance would get paid off, because they didn't have that option online. It was ridiculous. But that's the big bank. So I don't trust it.
So you mentioned a hard hit, and
Yep.
I imagine there's something called a soft hit as well. Is that these companies that say, hey, we can run your credit check and it's not going to hit your credit score? Is that
Yep,
what
that's
they're doing?
basic.
Something different? What is it they do different?
So it's how they actually do that. I mean, when you and Shane, when you get your own credit report and look at your own credit, that's a soft inquiry as well. When you're officially applying for, and I don't know how the system works that way, but when you're officially applying for something that credit-wise, a loan, any type of loan or a credit card, so it's an official application. That's a hard inquiry.
So you get pre-approved for a home or a car or whatever, because you want to go shop for this item you want to buy, and that pre-approval is probably a hard hit.
Good question. Let me get back to you on that. Does anybody know offhand? Because I knew that back like 5 years ago, but I forgot to take a look at that. But because I thought I recalled it was not a hard hit.
I just try to never do it. So I'm just curious if you know the delineation.
I got pre-approved with USAA. And that was, they said it was not, it was a soft inquiry.
Okay.
And so, but I'll follow up with that and take that as a lookup just to make sure, because that's important to know.
Alan, I
Thanks.
think it
Yep.
is a hard hit. This is Brittany, by
Okay,
the way.
yep. Hey, Brittany. I was trying to think the why, because I remember I was pretty certain USA told me it was not going to be a hard hit, but maybe it is, and it didn't matter because the pre-approval is what you need anyway to
Yeah,
get
if
the
it's like a
process
credit card
rolling.
application where they're gonna check your credit like that, if you're gonna get a new credit card, that is a
Yep.
hard hit.
Yeah, exactly. That's a hard hit. So in general, when you're applying for any loan or any credit, it is a hard hit. So yeah, but I'm just going to verify that, Shane. I think Brittany's right. I think it is a hard hit. I was just trying to think why USA. Maybe it was just so easy to get it within like an hour. That was getting the pre-approval was so fast. That was maybe something that I was thinking otherwise. Okay, so payment history, obviously most important. Secondly, though, the amount owed, that goes into credit utilization, as we're talking about. One of the things the key number there is keeping your credit utilization. So credit utilization is how much you owe, or how much you've charged compared to the total available balance credit that you have. So you would keep that percentage less than 30%. And better, like I think 11 out of 13 said they had it less than 10%, which is great. One thing to know though is, as mentioned, some people that starting small businesses or have operating businesses, they use the credit a lot, and then they pay it off each month, but they get this big bill, and their credit's getting hurt because it shows a large utilization. Well, in that, if you're in a situation like that, don't wait till the payment due date. If you have the cash, pay it immediately. You charge it, however, because I like to charge things. I try to put as much as I can on my credit card. And get the points, but then pay it off as quickly as you can. So if I have something really large, I'll even do that, because I'll see, even when I make some large purchases, like planning for a vacation, we're buying flights and all that kind of stuff, and or other things, like when I had emergencies with my dog, some serious big bills that came out all of a sudden. I pay those quickly before the bill even came off. That way, it didn't hurt my credit utilization. That makes sense?
Yep.
Okay. Let's see. Otherwise, and then the other thing, we'll go into it. I have that as homework, but ask your companies for a credit increase. Don't use it, but get a larger available credit, and that's going to improve your credit score if you're not spending anymore, because your credit utilization just immediately dropped. Based on that, how that number went, how that denominator, the total available credit, went up. So let's see the other
Yeah,
items.
but only do that if you're disciplined enough to not use
Exactly.
it.
That's what I said. That's what exactly. Don't. That's what we're getting the whole point of. And it's easy to use credit too much. Like it's amazing how harder it is for me to part with actual cash dollars than it is to throw a credit card or a debit card down. It's amazing how our human psychology works. The next item, though, length of credit history. This is the one I screwed up. Get your credit report and know what your oldest credit card is, and keep that one open. You need to charge it then. So, because companies will just close down a credit card if it's never used. So make sure you at least use it for some routine, routine bill, Netflix or whatever, something where you've got usage on it and you keep it maintained. But I screwed that up and closed a bunch of credit cards, and all of a sudden my credit history went down to like 2 years. And so did my credit suddenly dropped. I'm like, I'm an idiot. And then types of credit, that's so the more types of credit you have, the better. If it's just credit cards, that's one thing. But if you have a mortgage, if you have loans, I don't think there's no reason, in my opinion, to go try to get other loans to, improve your credit. But that's just how the system works. Is more, multiple types of credit is better for your credit score. Any questions there? Yep. pay on time, and keep your oldest account open. Okay.
Another little trick for keeping your credit score up is to pay before the due date, particularly 5 days or earlier.
Yep. And that Shane, that's exactly goes into what I was talking about, the credit utilization. Like if you make some large purchases on the credit card, pay it off before the due date. And the earlier you can, the better, because they don't. I've heard differing things there of when they actually track. You know, whether it's on the due date or some day of the month when they actually look at what your balance is compared to your overall credit. So the sooner you can pay those when you make a large payment, large purchase, the better. Thanks, Jane. That's a good point. Okay, so here just some average, numbers. Fortunately, most the people in this group had very high credit in general, which is great. But you can see, I'm not surprised that Gen Z has the lowest. They're young. But we're going to talk also how you can help your children starting building credit earlier. That'll ways to help them out. But you can just see in general, as age goes up, so does credit scores. Much of that history and hopefully lessons learned. Okay, this is the VantageScore that the three credit bureaus started. Very similar in terms of what they use, payment history. They call these as their influence. You know how influential it is to you. Payment history is 40% by 35. The amount owed, and that's broken down into utilization, balances, and available credit, which are kind of, I don't know, seems very similar to credit utilization overall, but that's and then depth of credit is like age and the multiple, different types of credit that you have, and then 5% recent credit applications. So Shane, those hard inquiries talking about earlier.
I never even heard of this one. Who uses this?
Yeah, so the credit, so Credit Karma uses it. That's actually the score you get with Credit Karma, if that's what you're using. The bureaus that they came up with it and been using it since 2006, but 90% of major lenders use your FICO score still. So, but it's good to check them both, both out, and they should be relatively close. VantageScore, you can actually get a credit history sooner, quicker than you can with the others. But as mentioned, keep it above 760. Okay, so I think we've already talked about this. Here's the big hitters on what negatively impacts your credit. As mentioned, new credit, but it doesn't last too long. But if you're going to apply for something important, don't apply for any credit cards. Closed accounts, that's one of my big mistakes, closing a bunch of those. And then obviously the big hitters on the bottom. Then bankruptcy, most things go off your credit report bought within 7 years, some within 2, which will show, but bankruptcy will last up to 10 years. I mean, it's terrible. I remember when I was like 19, living on my own, and a friend was, sadly, they let people get into these credit cards way too early. This person was, she was 20 years old and was wanting to file for bankruptcy because of credit card debt. I couldn't believe it. I mean, it's just horrific. But so how does your income and your assets affect your credit? What's that? They don't. That's the income level and pay raises don't, assets don't, but they do impact your ability to pay loans. That's the difference. It doesn't impact just like as far as a mortgage. There's a number of things that go into your your approval for it and what interest rate you're going to get and how much ultimately then you're going to pay. So those all do matter. And likely, I don't know, you guys probably see like your credit card companies will ask you what's your, every year or so, what's your income? And that probably goes into them assuming, nothing else has changed, whether they'll increase your credit limit. But I'm not certain about that. So now let's go into the cost of bad credit. So this you can see, this is, was just studies. This came out of my CFP studies showing, the specifics, comparing 760 to 850 versus 620 to 639. Big difference. That's like fair credit to excellent credit, but it shows a significant difference. Look at the percentage on a 30-year mortgage, 1.588% higher interest rate for fair credit. For a home equity loan, it's another 4.325%. A car loan, look at that, it jumps up 13.5% roughly for that difference in credit. And then you can see the differential monthly cost. This is for like a $250K mortgage. So I decided, let's look at California and San Diego, where most of us live. So looking it up, they're roughly it's crazy, but the current median home price in San Diego County is $901K. And so I did an assumption, and I actually worked with a mortgage broker that's actually the one that I use for both my home and for refinancing. He's great, and actually might help me do one when we talk about just home purchases. Do a dual Financial Fitness Friday with him. But 30-year fixed loan, and we ran through the actual numbers. This was done on Tuesday, where we took a 780 credit score versus the 700. And then I used the 620 to 639, just that differential you saw on the last page. So I added that in, and here's the differences that you'll see, between mortgage. I just made up some numbers for insurance and taxes. Like 1.08% property tax, and I think I said something like 4,000 for homeowners insurance, which I think is probably pretty accurate. Come up with the PITI that includes not just mortgage is the actual principal and interest payment alone, but look at the amount that you're going to pay difference by having fair credit versus excellent credit. That's another nearly $300,000 in payments if you didn't pay down extra. There's other factors though that go into this. Loan to value, which loan to value is, so the more you put down, the better it is, because it's the actual loan percentage. Like in this case, the loan amount 720,800, and the value is 901K, right? That's what you bought it for. So the more you pay down, the better your interest rate will be. Loan limits, that's conforming versus jumbo loan, which there's the actual number for has went up. Conforming loan in general in the US, meaning doesn't have to be a jumbo loan, is $726,200. Above that, you typically would have to have a jumbo loan. But in San Diego County, because in other areas where it's much more expensive, that gets kind of bumped up. So they still consider a conforming loan in San Diego County from $726,200 to $977,500. Despite it still being a conforming loan, it still jumps up like 0.5% above this 726. So it's kind of, it's not maybe a jumbo loan, but it's still going to be sadly a higher percentage potentially. And that's where, if you can get a VA loan, that might help with percentages in general. PMI, that's if you pay less than 20%, which I know a lot of people have to on their first home. Self-employed versus W-2, in general, W-2 is much easier to get a loan. Just like people in retirement, unless they have a lot of assets and they can show basically an asset and an income from that asset. And then debt to income ratio is the ability to get a loan. One thing, even the PMI score, we looked at that. This is how much credit matters. Even not only are you going to pay more your overall interest, but your private mortgage insurance, if you paid less than, is over double if you're just from $780 to $700 credit score. So that might not sound like a lot compared to all these other things, but still, isn't it? It's crazy. Any questions? The other thing that's interesting though is if your credit's poor, you might also have to pay more down up front, like pay 2 to 3 points, which 1 point is 1% of the value of the home. So in general. Any questions here? Kind of scary numbers, isn't it? Okay, anybody know what debt to income ratio is? And what are good numbers that lenders are looking at in terms of debt to income ratio? Brittany, you can't answer. Okay, it's the financial ratio between, it compares the borrower's total monthly debt payments to total monthly income. So if you have a house payment, a car payment, credit card payments, that's your total. Have you guys ever heard of like what percent of your monthly income? And this is gross income, by the way. So just so people know, so it's a better number than obviously net. That'd be much harder. It looks at your gross monthly income though. But anybody know what do lenders want in terms of your mortgage? What percent should that debt to income ratio be less than?
20 for the debt of the mortgage to 80% income.
Let's see. Well, okay, so you want actually they recommend 28, less than 28%. So your mortgage payment should be 28% or less of your total income coming in. Does that make sense? And that includes everything: your mortgage, your principal, interest, PITI, taxes, and insurance. And then they also want less than 36% total debt. So if you have credit cards, car payments, whatever else, home equity loan, all those payments should be less than 36% of your total debt. And 43% is about the highest ratio that you're gonna, debt to income ratio that you're gonna be able to even qualify for a mortgage. So something just important to look at.
I just to extend a word of caution here. Banks, they'll want you at your max.
Yeah,
so
yes.
Budget accordingly. And I'll tell you, I saved 3 percentage points by shopping around for different lenders and making them, earn my business. I literally gained 3 percentage points lower. So just be cautious, fit it into your budget. Numbers are a guideline only.
Yep. I'm trying to think, Shane, trying to think of what you ask them for. It's like a lender's something like lender's estimate. But
yeah, I'll dig it up here as soon as we finish this little segment here, and I'll put it in. I'll put a screen capture in the chat.
Okay.
But yeah, I used LendingTree to get one lender. I went to a local small credit union, and then I went to a broker, and I could compared all 3 of them with each other and just took the lowest deal.
Exactly. I did the same thing with 4, and I had it all on one Excel spreadsheet, just spread out, so you could see all the numbers. And exactly, it's your money. So
they have room to maneuver, and don't hesitate to negotiate. Go in there and say, yeah, I don't like that, and this guy here is giving me this interest rate. And literally, I could not believe the lady dropped it right there in front of me. I want your business. I'll give you this.
Yep. No, they will, because they're still making some. Exactly. So absolutely important. You have to shop around. And sadly, for the veterans in here, or ones that have USA and Navy Federal, they've got some of the worst grades. So don't think that they're helping you out.
Oh yeah, I did. I'm a veteran, and I did not go with USAA because they weren't the best.
They weren't even close. They were like a percent off. I mean, it was.
Yeah, that's right. And don't let anybody fool you. They're not your friend. So the banks used to be your friend, right? It used to be you knew the guy who owned the bank. Today they sell you a loan, and I'll tell you what, before your first payment, they'll sell that loan to somebody else to service it.
Absolutely. Banks have never been your friend though, in my opinion. So okay. Anything else on that last one?
No, and I'll tell you, if anybody wants to reach out to me, you're getting ready to buy a house, happy to help you and guide you in that haggle. I loved it. It was such a reward to me.
Yeah, and it's huge savings you're talking about. Like, I mean, just look at this difference, you know, in just a 0.5% difference. Look at how much that is. That's about, you know, it's $250 a month, but it's, you know, nearly $100,000 over the length of the loan. You just paid it off regularly. I mean, those little percent, you know, 0.5%, all of it matters significantly. Okay. Okay. Talking about building credit. One of the things is becoming, you know, people becoming an authorized user. Do this for your kids because it starts their credit history. You got to remember though, like we talked about keeping, you know, like I closed my oldest account. Well, if you do that to your kid, their credit history is gonna go away too. So, but you can do this and start building your child's credit history. They don't get to use the card, but they don't even have to know that they're an authorized user. But you're helping them out by starting their credit history earlier. You know, you can do this, heck, 10 years old, whatever. Other ways you can do it if you're having troubles, you know, applying for a secured credit card. Some of these are like where you put money down, basically, you know, up front. Take out a credit loan builder loan. I'm not a big fan of a lot of these, and I don't think anybody in here pretty much needs it based on the scores we had. But these are just ways you can do it. And the challenge is though, how do you get? This is what a lot of young people need that will help is getting credit for paying monthly bills, which is a new thing. Like I said, from 2016, but it's not a given. For like paying rent, it depends. Your landlord has to report that, so they might not report it, and they're not required to report it. But especially if it's like an apartment or something like that, or even landlord, that it's something to ask them to, and they should be willing to do this because this is significant and not no skin off their back. But here's some services people can use that offer this kind of reporting, which helps that payment history that so many people are lacking when they're young. You know, good ways to get those added in to built into your credit history. They add these what they call trade lines, that are all the different types of, you know, accounts that you have basically that are showing. But rent reporter and simple bills, those are like some third-party vendors. They're a little more expensive, but these are just, you know, opportunities that you can, where you can get you build your credit history better, with non-classical, I guess, means. Okay, how long does it take to repair credit? Oops, I see there's a bunch in the chat. Okay. Oh, there's Fair Isaac Corporation. Yeah, sorry, I can't monitor chat very well while I'm doing these. So if you do, it's better just to speak it out. Okay, so repairing your credit. Like Shane, we were talking about early, hard credit inquiries. They stay on your credit for 2 years, but within a few months, you can improve those. And if you get more credit, now you've got a larger credit available. And so I've seen like hard inquiries, you know, you'll see a number drop a little bit and then it goes right back up within a few months. Just don't do it if you're applying for something important. Don't minimize all your hard inquiries when you're getting ready for important purchases like a home or a car, something larger. Interesting. But you see these things last quite a bit. Late payments. If you get a late payment, call your bank, call the company and say, hey, can you take this off? I'm sorry, you know, just talk with them. They're humans, and they'll probably remove it so you can get that taken away. You can also even call to ask for a lower interest rate. Hopefully, you don't even need it because you're not paying any interest by paying off your balance on time and in full each month. But the big bankruptcy, obviously, and tax lien, 10 years, that's on there. But they say roughly if you wanted to take your credit score from 500 to 700, you could do that within 12 to 18 months, if very proactive about it. But it could take, several years to go from 650 up to 800 just to build that overall credit history. They say, because like the amount of time, like the length of the credit history, you need at least 2 years before it even really counts. Then there's 2 to 4 is good. It adds some points to your credit history. And then 7 to 10 years, that's where you get to like the highest marks. From 7 to 10 years and above, that's how much you want your credit history to be to really get the highest benefit from that portion, that 30% portion of your. Okay, hit enter. Okay, here's 10 reasons why you pay with a credit card. The biggest thing is safety. You can avoid losses with fraud. If you get a fraudulent charge on your credit card, you're only liable for $50 total at most. That's a rule law. Insurance protection. There's whether it's car insurance protection, travel insurance. There's a lot of protection. Whereas you use a debit card, that money's gone immediately, and you don't have the same kind of protection. Then all the rest of this stuff, like keeping vendors honest, is important. But a lot of that is just, hey, okay, now we're getting into what I put down, the 7 through 10. That's what we'll talk more about next time on travel hacking. But you got to make sure you're being smart and not using credit wisely, because points are not worth the interest payments or the impact hit to your credit. Okay, freezing your credit. That's actually a link. And I like Clark Howard has that. It goes right to his website. As it shows how simply you can do it. The businesses, all three of they're federally mandated that they have to freeze it within 1 business day, and then to unfreeze it, it's simple as well, and they have to unfreeze it within an hour. So it's but just in general, keep your account frozen. There's no reason that's the best thing you can do from somebody taking your identity and opening up accounts, etc. Credit lock, that's like LifeLock and stuff like that. It's not actually as good, nor is it really guaranteed. It's not really federal law or anything. So really, credit freeze doesn't cost you anything, and it's better in general. So I can also send the link to everybody that's interested. But while you're not I'd freeze all your accounts, freeze your credit now with all the 3 credit bureaus, and just keep it frozen until you have to apply for something. And then you unfreeze and then refreeze. But in general, just keep your account frozen. Best thing we can do to thwart the criminals. Okay, sorry, I know we're running a minute over, but here's your homework. If you haven't paid off your credit, I don't know if you guys have checked out Vertex 42 calculators, but they've got some incredible calculators for free download, whether it's from credit cards to mortgages to what have you. They've got these amazing free calculators to use. Be wary of debt consolidation. If that's, I was just talking to somebody recently about that, and what I've seen too often is you're not fixing the root cause of the problem. They'll use that and then they'll go right back into credit card debt. It's a vicious cycle until you get to stop the excessive spending. But get your free annual credit reports. Know what your oldest credit card is and keep it open. And like I said, you need to use it to keep it open. So doesn't mean you use it a lot, but just use it regularly so that they don't decide to open it. Ask for credit limit increases. Don't use it, as we talked about, but that'll lower your credit utilization, increase your credit score. You could also apply if you're a homeowner for a HELOC, home equity line of credit. That's like a revolving, it's like having a credit card, but a home equity. So it's not an actual loan until you take money. But you could take it. People used to use this as an emergency fund. Terrible idea, because like when 2008 happened, everybody's home equity dropped. All HELOCs pretty much went away. Suddenly people that were relying on that as a potential emergency fund had no emergency fund. So don't do that. But it's one way that you can increase your credit, even though you don't need to use it. And it's there for in case of emergency. Does that make sense?
Yes.
Okay. Then, once you're responsible, now we can, next part 2, we'll talk about taking it to the credit card companies. Okay, here's another topic. So we'll put out for future ones, but if you guys have any others that you think you'd like, let me know. Just shoot me a note and I'll add it to the list. And then here, these are the veteran specific topics. Later in October or November, I'm going to do the factoring in any pension or disability into retirement planning. And then we'll do the rest of those quarterly as we go on. So
Backdoor Roth IRA, you may have talked about that in the past, but if
Yep.
you could put that on the list or point me to the audio that has it, that'd be great.
Yep, sure, absolutely. And Shane, there's important. I'll point you to that. Backdoor Roth is great if you're over the income limits. The big concern there is if you already have a lot of money though in any traditional IRA, then the backdoor Roth IRA doesn't make sense because of what's called the pro rata rule. And if you want to, Shane, if you want to stay on, I can stop the recording and we can just go over that. And anybody else that wants to listen. But here's some quick questions for you, and be honest. If this was, I'd like these to be useful for everybody. So let me know if how we can improve these. Any questions?
Thank you, Alan.
Okay, thanks. Well, I'm going to stop the recording and I'll stay